Welcome back, everybody. Today we're talking about the monthly dividend company, Realty Income. Realty Income is a favorite among dividend investors and a company that I can never say their name right. So let's say you want to buy a share of Income Realty. You have a stock like Income Realty. In the case of Income Realty, stock. So I'm going to try my best not to screw that up in this video, but if the folks at Realty Income would like to go ahead and change their name on my behalf,
that would be great. Okay,
let's jump into Seeking Alpha, and we see that Realty Income is currently trading at $59.01. Over the past year, it is down 18.95%, and year to date, it is down exactly 7.5%. It has a dividend yield of 5.08%. If we go to the dividends tab, we see their dividend yield, and they have an annual payout of $3.07. A funds from operation payout ratio of 73.85%, a 5-year dividend growth rate of 3.73%. In terms of consecutive years of dividend growth, it says 2 years here, but pretty sure it's more than that. If you go to Realty Income's own website or like dividend.com, it says that they've had like 30 years of consecutive dividend growth. So regardless of kind of what it says, they've consistently paid and grown their dividend for a long time. And if we just take a look at the dividend history, we can kind of see that like the reason why there's so many is because they actually pay monthly and not quarterly. So they're consistently paying their dividend every month and growing it. Now, if we go to the profitability tab and we look at the gross profit margin, you can see that it's 92.99%, which is really high. And when you compare it to the median of their sector, it's quite a bit higher than that. So that's good. Their net income margin as well is over 25%. And when you looked at the median for their sector, it's like half that. And so the other thing that I look at for REITs is the FFO interest coverage ratio. So first of all, FFO is funds from operations. And that for a REIT is basically like cash flow from operations that we look at for a stock. It's the amount of cash that they're generating just by running their business. And anytime a company has a lot of debt, one of the things that you want to know is, do they have enough cash coming in to at least pay off the interest expense on whatever debt that they hold? Because in a nutshell, it helps you understand if the operations are solvent to where they're earning more cash than they need to spend out to keep the business going. So in Realty Income's case, their FFO interest coverage ratio is 5.42, which means that the cash that they have coming in can pay off their interest expenses over 5 times. That's really healthy. And then lastly here, we'll look at the momentum tab, although it doesn't really make a ton of sense to do this. Being that it's a REIT and it's, Realty Income, I don't know that comparing it to the S&P 500 is the right thing. And we're going to talk about that a little bit later in the video, but we'll take a look at it anyway. So if I look at the total return versus S&P 500 over the 5-year, Realty Income's underperformed, which I would expect. Under the 10-year, they also underperformed. And then over the past 30, it's actually outperformed by quite a bit. But I think this is a little bit misleading because as you can see, Realty Income was issued in October of 94. So there's a lot of variables that can happen when a stock goes from IPO being issued to, 30 years later and it way outperformed. So I don't know that that tells us a lot. It's just a piece of data. Okay, so now that we have an idea of what's going on with the stock, let's talk about what's going on in Realty Income's business. Now, Realty Income is a well-run company with a strong, consistent business. And one good example of that is looking at how their AFFO actually increased during 2020 and 2021 when we had the pandemic going on. Because you would think that retail real estate would have been pretty impacted as everyone stayed home, but they actually kept growing their AFFO. And just for clarity, AFFO is a slight tweak to what we talked about before. You have funds from operations, and AFFO is adjusted funds from operations, which is basically the cash that they bring in minus any expenses that they need to keep the business running. For normal stocks, what we do to get free cash flow is we take cash from operations and we minus capital expenditures. AFFO is kind of like the same thing, but for a REIT. And a couple of the interesting things that have been going on for Realty Income lately is one, they just raised $1.2 billion of new debt at a rate of about 5%. In addition to that, they announced that they invested $2.6 billion in properties to expand in April and May. And those properties have a cash lease yield of 6.8%. Now, I'm not an expert in this space by any means, but what those numbers mean to me in my simple brain is that they're able to borrow money at a cheaper rate than they can earn from the properties that they're buying with that money. So in this case, it's roughly a 1.8% spread, and that spread should ultimately hit the bottom line of their financials. And Realty Income just had their Q2 earnings call, and they beat expectations on revenues as it was above $1 billion. They also had a normalized funds from operations per share of $1.02, which was in line with analyst expectations. They announced same-store rental revenue was $718 million versus $719 million last quarter, and they continue to have an occupancy rate of 99%, same as last quarter. Realty Income slightly adjusted up the bottom range of their FFO guidance per share, and they also increased their acquisition guidance from $6 billion to $7 billion. So what does that all mean? It means their business has been good, it's been steady, and they're looking to expand a little bit faster than they originally planned. Okay, so now what about valuation? So if we jump into the spreadsheets here for valuation, as you can see, since Realty Income is a REIT, there's some slight things that are changed here. So instead of price to cash flow, I'm looking at price to AFFO. Instead of return on equity, I'm looking at FFO to interest coverage ratio. So just some slight tweaks just because it's a REIT. All right, so if we look at the buy and hold recommendation, now in this buy and hold recommendation, I'm using AFFO instead of cash flow from operations and capital expenditures like we talked about before. But we are still removing dividends paid and we are still removing stock-based comp. So once I put the data in for AFFO, dividends paid, stock-based comp, and total common equity, then it comes out with the fair value price per share of $57.65. And so let's talk about some of the assumptions that I made and whether or not they make sense. In terms of starting cash flow, I used 506.10, which is the most recent trailing 12 months number. You could argue because there was a big jump between 2021 and 2022 that using the average free cash flow might be a more conservative number, but I ended up using the most recent. In terms of starting growth rate, I chose 12%. Now, if you look at the calculated value, it's actually over 30%. Now, I'm not going to put over 30 in my calculation, but when I went back to Seeking Alpha and I looked at their projected growth, their FFO growth is projected to be 12.78. Now, the historical growth is a little bit over 7. So you could argue that maybe it's better to split the difference, maybe make it 9 if you want to be more conservative. I ended up choosing 12 just because my calculated rate was 30. The projected rate is 12. You just have to understand that if they don't end up hitting that 12% growth rate, then your model may be way off. In terms of terminal growth rate, I'm using 2.5, which is just a general number about how much the economy grows by, even though I think right now it's a little bit less than that. For required rate of return, I'm using 12%, and I've talked about this a bunch as to why I do that. It's every stock that I look at, I'm comparing it to my potential return of just buying the S&P 500 index. But the problem with that is that comparing Realty Income to an investment in the S&P 500 isn't really apples to apples, and I want to dig into that in a minute. But before we do that, let's jump into the multiples valuation and see how it looks. So in the multiples valuation, I added some peers like Simon Property Group, Kimco Realty, and I added all their price to AFFOs. Now, because this is a REIT, I don't use price to cash flow. We're using price to AFFO to be able to compare them. So after adding all the price to AFFO information, it spits out a fair value price per share of $54.24. So when we compare our valuations to the analyst target mean price of $69.71, we see that ours are coming in a little bit lower than that. But let's go back to this buy and hold valuation. Now, the problem with having a required rate of return of 12% is that Realty Income is really a different type of investment. Because when people look at the S&P 500, it's looked at as a core portion of a portfolio, whereas Realty Income or other REITs are more of a complement to help balance out your portfolio and gives you exposure to different asset classes. And this is where really understanding what our own individual goals, risk tolerance, and time horizon are for our investments is critical. And just as an example, if I change this required rate of return, let's say, you know what, I only require 8, then all of a sudden the fair value price per share looks a lot better. So overall, back to Realty Income, are there concerns about inflation and rates persisting, which will impact all stocks, but especially REITs? Yes. Are there potential concerns about a slowing economy and retail real estate being impacted? Yes, although I do think Realty Income's tenant portfolio is better than most at being able to deal with that because they are more, good retail locations and tenants as opposed to like office buildings. So if you're looking to balance out your portfolio with a strong, steady dividend payer that gives you exposure to retail real estate and some price appreciation, then yeah, Realty Income is a strong choice in my opinion. And I don't think it's overpriced at these levels. I think it's pretty fairly valued. And obviously in the short term, we never know what's going to happen, but they have this history of being a steady, resilient performer that can add something to your portfolio, as long as you understand why you're adding it and what role it plays in your portfolio. Hopefully that makes sense. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace. I don't know if you guys saw whenever I show my portfolio that I have this little one share of Realty Income there. It's because I made a video a couple weeks back about how to buy a stock and what a market order is and what a limit order is. And the account that I was using just happened to have the right amount of money to buy one share of Realty Income. So that's what I did. So I have my one little share of Realty Income, compounding every month. Let's go.